Welcome to an introduction to the Real Options Superlattice Solver software, a quick test drive brought to you by Real Options Valuation Inc., the makers of Real Options Superlattice Solver and Risk Simulator software, applicable for real options analysis, risk analysis, Monte Carlo simulation, forecasting, optimization, and general statistical analysis. By way of introduction, I'm Dr. Jonathan Munn, the founder and CEO of Real Options Valuation Inc. I'm the author of 7 textbooks, including Real Options Analysis, first and second editions, Real Options Course, Applied Risk Analysis, Modeling Risk, first and second editions, Valuing Employee Stock Options, and others. I'm also the creator of the older Real Options Analysis Toolkit and the newer and more improved Real Options Superlattice Solver, which you will see in a moment. I'm also the creator of the Risk Simulator software, which will also be showcased in a separate segment. So let's get started with the Real Options SLS software. If you have the Real Options Superlattice software installed, all you need to do is click on Start Programs, go to Real Options Valuation, and underneath you will see Real Options Superlattice Solver, or Real Options SLS for short. In here, there is a user manual, a highly comprehensive user manual that follows a lot of my books. There is also this SLS function, which I'll show you in a moment, SLS Solutions, Single Asset SLS, Multiple Asset SLS for multiple underlying assets, or also for multi-phased assets. So for example, a sequential compound option, phase 1, phase 2, phase 20, for example. Multinomial lattice solver that uses trinomials, quadrinomials, pentanomials, and so forth. A lattice maker that creates lattices that are linked and where all the equations are actually visible. And finally, a bunch of sample files. For example, abandonment American options, European options, customized options, barrier options, a bunch of case studies, employee stock options, option expand, and so forth and so on. So we'll definitely have some fun doing that. First of all, let me show you the SLS functions. If I click on that, you will see a quick splash screen come up, which means something is actually occurring. Here's an example that I use in class or in one of my training DVDs, whereby you were trying to create an American call option manually by doing a 5-step binomial lattice in this case. Now some of these computations could be quite cumbersome. For example, here's Black-Scholes result, and here's the function for Black-Scholes result. It takes quite a while to actually do this, and you're not even sure if the results are actually correct. And also, here is an equation for performing a 5-step binomial lattice. So you have to go through all the motions to perform multiple complicated calculations to get this value of $12.79. Conversely, what we can do is, utilizing the functions that we just started, click on a cell that we need, for example, the Black-Scholes result, click on FX or insert function, or just click on insert function, go to all in my function dialog box, scroll down all the way to SLS, because we're using the SLS functions, so superlattice solver, and find the function that we need. For example, SLS generalized Black-Scholes call option. So it tells you returns the European call option using the generalized Black-Scholes. Click on OK. Bring it over. Link to all the cells that we need. So 1-year maturity, 5% risk-free rate, volatility of 25%, a dividend of 0 or whatever the percentage is. Click on OK, and there you have it. Here's your Black-Scholes equation. Very simple. Takes you about 5 to 10 seconds to actually execute, compared to doing this manually, which could be quite dangerous. Also, we can actually figure out the lattice result using a binomial lattice, using the same approach. Come down here to SLS. So we'll find the relevant model that we need, SLS binomial American call option in this case. Click on OK. Select the relevant cells that we need. And 5 steps. And voila, we get exactly the same answer instead of having to go through all these motions. In fact, this is only a 5-step lattice. Imagine how large the model would be if you do a 100-step lattice, which will be impossible to solve, by the way, manually. So all I need to do is come down here. Instead of putting 5, I can do 100, and the answer is 12.3113. If I do 1,000, wait for about a second, and the answer is 12.3335. Hit OK. And guess what? On a 2 decimal basis, the 1000 step binomial lattice is identical to a Black-Scholes result. So very simple, yet very powerful. And because these are functions, all I need to do would be to change any of these inputs and obtain an updated output in this case. Therefore, I can literally run Monte Carlo simulation using Risk Simulator on any of these inputs and obtain a forecast of the results in this case. So very powerful, very simple, and very potent approach in this case. Next, we can come in here and use real option superlattice solver and start on the single superlattice solver equation. So if I click on this, if I check American option and European option, so here's a single asset SLS. If I were to put in the same exact input in this case, $100 in the underlying asset, 100 on implementation costs, 1 year maturity, 5-step lattice, 5% risk-free rate, 0% dividend, and 20% volatility. If I click on run, it takes but 2 seconds to obtain the results, 12.79, which confirms the result that we have on here, $12.79. I can even select on create audit worksheet, click on run, wait for several seconds or so, and voila, a worksheet is actually generated for me. The worksheet that you saw a moment ago with the European option and American option generated. So this is the single asset SLS. You can also come in here, do the same exact thing, but pull up a sample file for the single asset SLS. For example, let's just choose an American customized option or American abandonment option. Either one of these will work. So here's an example that we have. So this example is as follows. Let's say you own an asset, an R&D project, a patent license, or a piece of land, let's say. Let's say you own a piece of land and we do some valuation, and a piece of land is worth $120 million using income approach, cost approach, market approach, or you can hire an executive consulting firm to come in here and do the evaluation for you. And let's just say there is another counterparty out there, say owned by Donald Trump, you know, the real estate mogul, who wants to purchase this piece of land from you. And both of you know it's worth $120 million. He calls you up 50 times a week. Actually, his secretary calls you up 50 times a week. And you say, well, I'm not interested in selling you this piece of land. But then you come to think of this in terms of a real options world, and you say, well, perhaps I can take advantage of this situation by utilizing real options. So you call Donald or his representatives for a meeting, and you say, well, have I got a deal for you? The deal is as follows. Now, this contract that you're about to sign lasts for 5 years. So you have a maturity of 5, such that at any time within these 5 years, I, the holder of this piece of land, have the ability to pick up the phone, call you, and execute this option and sell you this piece of land for $90 million. So a salvage value of $90 million in this case. And you have to purchase it from me at $90 million. Now, you know that the land has a volatility of 25%. So the price of the land is highly volatile. It could be a lot higher or lower. If it goes up to 140, 150 million, well, if you need to get rid of the piece of land or asset, sell it in the market for 150 million. But if it is below 90 million, stays there at 60, 70 million, you can pick up the phone, call this person up, and execute this option to abandon. So now you have literally created yourself a safety net, an insurance policy of sorts. So if you look at a normal distribution, you're chopping off the left tail of that distribution, the risky side, at 90 million. So what happens is the width or the risk of this distribution decreases. So you have risk reduction, and the expected value shifts to the right. So value enhancement, risk reduction in this case. So you can solve it using 100 steps, or let's say a 10-step lattice. We'll click on run. It takes about 2 seconds to compute. If you put 100 steps, it will probably take about 5 seconds. So here, the American option tells you that it's worth 125.4831. What that means is, if your asset, project, or piece of land is worth 120, the additional 5.48 million comes from the option value, this insurance policy. If you're buying this insurance, it will cost you something. Well, in this case, it's worth $5.48 million. So you bought yourself a safety net in this case. So that's an option valuation. Now, you can come in here and put in any sort of equations in the terminal node, intermediate node, or blackout steps where you have a Bermudian option, where you can only exercise this option at a particular date. So say every 3 months or every 6 months and so forth. European option tells you can only exercise at the end of termination, at the end of 5 years. American option tells you can exercise any time between now and 5 years. Therefore, the American option is worth more than the European option in this case. Okay, this is a very simplified example. We can actually get a little bit more complicated, and that's why the courses, the training courses that I teach, the books that I have, or the training DVDs are so important, because you can get really interesting with these, because you can customize this as much as you wish. For example, here's an employee stock option with vesting periods, blackout periods, with suboptimal exercise behavior and forfeitures. Notice that the equations right here in this case could get a little bit more complicated, and therefore you would need a software like this to compute. Otherwise, it would be extremely difficult to compute manually. In fact, you probably can't do it manually in this case. So I can create customized variables, create my own type of options, a la carte options, anything I need to do, and I can actually do it here. Now, compare that to utilizing something called a multiple sequential compound option, where we have, say, a multiple phase complex sequential compound option. In this example, I have a 3-phased option. If you can do 3 phases, you can probably do 10, 20 phases on your own. And you can use this multiple asset SLS solver to do it. And you can create customized variables, customized computations to make a decision in terms of how much is this option actually worth, phase 1, phase 2, phase 3 options. Or you can come in here and get a little bit more advanced, if you wish, and do things along the lines of, say, a jump diffusion or mean reverting option, for example. So I can pull up a multinomial SLS solver and compute things like a trinomial lattice to obtain some values, or mean reverting trinomial lattice, where the underlying asset actually follows a mean reverting process, like interest rates and inflation rates follow a mean reverting process. You don't have inflation or interest rates that is out of control, for example. Or a jump diffusion process, such as price of electricity or price of oil, for example, that follows jumps. Or rainbow options, when you have multiple interacting options that has a correlation in this case. Conversely, you can come in here, do the same exact analysis using something called the SLS Excel solution. So rather than the pop-up dialog box that you saw a moment ago, all you need to do is come in here and put all these things in an Excel environment, because the result is nothing but an equation, SLS single asset, for the SLS solver that you saw a moment ago. So you can create your own custom variable list. In this example, we have an abandonment option as well, and the salvage value actually changes over time. So for the next 5 years, we have 90 million, 95, 100, 105, 110 million. So we have a changing value or changing salvage value option for an option to abandon in this case. And we can create any complicated, customized a la carte option as you wish, and all you have to do is enter those equations appropriately. Same thing occurs for the multiple asset superlattice solver, where there are multiple phases. So you can go 10, 20, 50 different phases if you wish, and obtain the multiple asset SLS result in this case. You can also do changing volatility options, where options are changing volatility over time. For example, here we have volatility at 20% for the next 5 years, and after that it changes to 30% and so forth. So all these are modeled in the real options superlattice solver. It's a lot more powerful than the predecessor option models that I've created. So the SLS is a la carte. If you can think it, you can solve it, and you can create your own. And in fact, because all these things are linked together, all you need to do is run a Monte Carlo simulation on any of these inputs, and therefore capture this as a forecast. If you're interested in Monte Carlo simulation, definitely download and watch the other segment of this presentation, where I look at the risk simulator, Monte Carlo simulation, where you can run simulation, optimization, forecasting, as well as general statistical analysis. So this concludes the presentation for the Real Options SLS software. If you have any questions, feel free to contact me after this at admin@realoptionsvaluation.com, or feel free to again visit our website at www.realoptionsvaluation.com. Thank you.